Welcome to the Pro Ticker Deep Dive. Today, we are diving deep into the infrastructure that powers every single trade you make. We're talking about market making. We've gathered a stack of sources that, well, they describe this profound transformation happening just beneath the surface of the equity markets right now. And we're looking specifically at what's unfolding across 2024 and into 2025.
Our mission today is really to give you a shortcut to understanding these major structural shifts. We'll be exploring the fierce technology arms race, the rise of algorithmic players, this increasing fragmentation of trading venues.
And crucially, what it all means for your trading costs and, market stability.
Exactly. For any investor, the core question is always the same. Who is actually buying when you sell and selling when you buy? And that answer is changing at, well, microsecond speed. We really need to get into the new mechanics.
Okay, let's unpack this. We have to start with something that might feel a little counterintuitive. I mean, you might trade stocks with zero commission, but you are still paying an unexpected cost. And the sources say that cost is actually rising dramatically.
Absolutely. We have to begin with the concept of the bid-ask spread. For decades, market makers were the backbone of the system.
The liquidity providers.
Right, the designated liquidity providers. They essentially guarantee that a trade can happen immediately. Firms like Citadel, Virtu, Susquehanna, they were the gatekeepers of pricing and access. They made their money capturing that tiny difference between the highest bid and the lowest ask.
And the common wisdom was that as technology improved, that spread, that friction you pay it, should get narrower. But the sources reveal a pretty shocking metric looking at the period through August 2025.
Oh, it's really something. The daily average bid-ask spread in U.S. equities is holding at about 50% wider than it was during the same period just a year earlier.
50%.
50%. That's not a small cyclical fluctuation. It is a massive structural leap backward in terms of the cost of liquidity.
That figure is just staggering. So let's translate that 50% wider spread into real-world impact for you listening right now. What does that mean for your portfolio?
Well, the analysis shows it translates directly to a 36% rise in the daily cost to trade compared to last year.
Wow.
And you have to think about that compounding effect. If you're an active trader or you manage a portfolio that rebalances frequently, that 36% rise in friction, it just compounds significantly over time. It's like an invisible tax on your execution quality.
So even if your statement says zero commission.
Exactly. If you're trading, say, $10,000 worth of shares a week, that extra slippage could translate into hundreds, maybe thousands of dollars in unexpected costs over a year.
It really makes the free trade feel a lot less free than advertised. So we have to understand why. Why are the spreads getting wider despite all this tech we're about to talk about?
The sources point to two main interconnected forces.
Mm-hmm.
The first is pretty straightforward: heightened market volatility and inventory risk. When the global economic picture is uncertain, geopolitical instability, surprise inflation reports, the Fed constantly pivoting, the risk for a market maker just shoots up. They're holding inventory. If prices suddenly drop 10% while they're holding millions of shares, they take a massive loss.
So the wider spread is basically their insurance premium.
That's a perfect way to put it. It's compensation for that increased risk of holding inventory. They're saying, look, we need a bigger buffer because the market could move against us violently at any second.
Mm-hmm.
And the second factor is the one that seems truly paradoxical: fragmentation. The simple fact is that trading activity is no longer just on the NYSE or NASDAQ. It's spread out across dozens of venues.
Exchanges, dark pools.
Alternative trading systems, everything.
Wait, I need you to unpack that paradox. More venues, more competition. Shouldn't that mean lower costs? Why does fragmentation make spreads wider?
It's the aggregation challenge. For a market maker to post a really tight competitive price, they have to know in real time where all the offsetting liquidity is. If the total order book is split across 40 different places, the has to run 40 simultaneous checks, reconcile them, and account for all the latency differences. That complexity just increases their operational risk.
So the moment they commit to a price, they have to be sure they can manage that inventory across this incredibly scattered ecosystem.
Precisely. If they can't reliably pull all that liquidity together, their risk premium goes up. So fragmentation, instead of driving costs down, actually drives spreads wider.
And this is where it gets really interesting. That inability to aggregate liquidity efficiently is exactly why they're now investing billions into AI and low latency tech. The whole game has become a contest of pure technological prowess.
This is what the industry calls the electronification of everything. It's this massive macro force driving the wholesale migration of trading away from those traditional visible exchanges.
And the numbers on this are dramatic.
They really are. Off-exchange venues now consistently account for more than half. We're talking 50 to 55% of total reported trading volumes in 2025.
More than half.
That is a stunning reversal from just a decade ago. And this shift is entirely enabled by the ability of these non-bank market makers to process and match orders faster and cheaper than the old exchanges can.
Which feeds directly into this new oligopoly structure we're seeing. These non-bank market makers and high-frequency trading, or HFT, firms now account for close to 45% of all trading volume.
They're absolutely filling the vacuum left by the traditional dealer banks who just couldn't keep up with the infrastructure demands.
Yeah.
And at 45% participation, that speed advantage becomes everything.
So they aren't necessarily making money by creating a new price, but by acting on price changes faster than anyone else?
That's it. HFTs operate with a kind of informational asymmetry because they can anticipate price movements and trade microseconds faster. You can almost visualize it as them seeing the order book one page earlier than everybody else.
And the research backs this up.
It does. It shows that the aggressive HFTs, the ones taking liquidity, generate significantly higher profits than the passive ones who are just providing it. It's a relentless technology arms race where latency, that time delay, determines who survives.
Let's pull up that data snapshot from the sources, the chart tracking 2023 to 2025, because it tells a fascinating story.
What really stands out is the divergence. Over that period, you see trading volume and non-bank participation just surge. I mean, non-bank participation is up 80%.
So more volume and a more concentrated group of tech firms are processing it.
Right. But at the same time, paradoxically, the bid-ask spreads also widened by 50%.
And that's the key takeaway here. You've got this mix of cyclical volatility driving up risk alongside the structural fragmentation that concentrates volume among a few very advanced players.
Which leads us right into the hyper-competitive landscape that's defining 2025. The whole function of providing liquidity is democratizing away from the old banks and toward these specialized capital-intensive firms.
And we can actually track that intensity by looking at the cost of retail flow. We're talking about payment for order flow, PFOF.
Yeah, that's the mechanism where market makers pay brokers, like Robinhood, for the right to execute their customer trades.
And that number has now surpassed $1 billion per quarter.
$1 billion. It's driven by this record, sustained retail participation. The market makers are fighting tooth and nail for the right to interact with those retail dollars, mostly because that order flow is considered uninformed.
Meaning it's less likely to trade against them profitably.
Correct. And that fight is eroding the market share of the big two. While Citadel Securities and Virtu Financial are still dominant, we're seeing new, nimble players gaining traction incredibly fast.
Like Jane Street.
Jane Street is the perfect example. They paid $54.5 million for retail option flows in the third quarter of 2025. They'd only entered that market one quarter earlier.
Wow. And you have others like Hudson River Trading and Two Sigma also chipping away at market share.
Exactly. That $54 million outlay for just one quarter's access shows you how incredibly high the stakes are.
And this whole PFOF system, it creates this self-reinforcing loop, doesn't it? The competitive bidding for flow incentivizes brokers to grow their retail base, which lets them offer free trades.
It's a very efficient system for the broker and the market maker, but you can see the competitive pressure in the margin data.
The Robinhood data.
Yeah, the Robinhood options flow commanded what, about 53 cents per contract in Q3 2025. That was down from 56 cents in Q2. That little compression shows hyper-competition is narrowing margins.
And all of this is changing where the trades actually happen. We mentioned alternative trading systems. They used to be for big block trades.
And now they're processing millions of small retail orders in real time. It's a radical shift in market topology. We're moving away from a traditional hub-and-spoke model, centered on the big exchanges.
To what the sources are calling a mesh network market structure.
Precisely. Every ATS, every dark pool, is a node. And the market makers are the connective tissue that routes and executes orders across this vast decentralized system.
Okay, let's pivot to the rulebook. Regulatory uncertainty is incredibly high, and the sources point to a major political event in mid-2025.
They do. What happened was the Trump administration, in mid-2025, repealed multiple key SEC proposals, and critically, these included rules targeting PFOF and something called the Order Competition Rule.
So what was the order competition rule supposed to do?
In short, it was designed to force a small portion of retail order flow to be exposed to open competition before a market maker could just internalize it.
So it was a direct threat to the PFOF business model.
A huge threat. By repealing it, the administration created this environment where MMs enjoy very favorable regulatory conditions, even as the structural and technological pressures are mounting. It's a real paradox.
But it wasn't a total free-for-all. The SEC's December 2024 amendments to Regulation NMS did bring some changes.
Yes, some specific ones. They introduced new minimum pricing increments, what they call the half-penny tick, to try and tighten pricing. And they enhanced transparency. But the analysis suggests the MMs, with their superior tech, just adapted very quickly. The core practices were left largely unscathed.
Before we look forward, it's interesting to look at the parallel universe of DeFi. How do automated market makers there compare?
It's fascinating because it's the ideological opposite. AMMs in DeFi use smart contracts and community liquidity pools to set prices algorithmically. No intermediaries. It's permissionless, accessible to anyone.
A fully democratized market maker, so is it more efficient?
Not yet. AMMs often trail the prices on centralized exchanges, and that results in arbitrage losses and slippage for the people providing liquidity. The tech is resilient. Billions flow through them daily, but they still lag behind these ultra-low latency centralized HFT systems.
So it proves technology can democratize liquidity, but for now, efficiency still lies with the massive capital and centralized tech of the non-bank MMs.
That's a great summary.
Okay, so bringing it all back, what does this mean for the future of trading? The sources suggest MMs are simultaneously more powerful because of tech, but also more vulnerable because of competition and regulation. What's the outlook?
Well, there's a strong bull case. First, technology is enabling totally new market structures and new asset classes, like tokenized bonds and fractional ownership. MMs are perfectly positioned to provide liquidity there.
And the retail army isn't going anywhere.
Right. That's the second point. Retail participation is at these record-sustained highs, which stabilizes profitability for MMs on a much higher plateau than a decade ago. And third, there's this huge emerging opportunity in 24-hour trading.
To accommodate Asia-based retail?
Exactly. And overnight price movements. It creates a whole new window for liquidity provision and profit.
Okay, so conversely, what's the bear case? What are the big headwinds?
The bear case is dominated by risks outside of their technology budget. First and foremost, regulatory risk. A future administration could easily bring back those rules targeting PFOF.
That would force a total redesign of their business model.
Completely. And more immediately, the SEC's new Rule 605 disclosures will provide way more granular data on execution quality than ever before. That will absolutely fuel future reform efforts.
And the fragmented structure they dominate could become a liability.
That's the second risk, fragmentation risk. This mesh network is great until the system comes under severe stress. During those sharp volatility spikes, like we saw in April 2025, fragmented venues can suffer severe liquidity evaporation.
If the MMs suddenly pull their quotes because the risk is too high?
Now, it creates a cascade of volatility and illiquidity, which would bring massive political pressure for immediate reform.
And finally, the tech itself.
Right. Technology commoditization. The moat is narrowing. What's a competitive advantage today? A specific AI model becomes table stakes tomorrow. As more firms get access to better tools, the profit margins for just simple passive liquidity provision get squeezed even more.
So, final verdict for the market makers themselves. How do they survive this?
Success requires a combination of three things: capital at scale, unquestionable technological sophistication, especially in AI and machine learning, and very savvy regulatory navigation. I think you'll see continued consolidation among the giants who can afford the arms race, and specialization among the smaller players. The days of being a simple price provider are definitely over.
And why you should care about this, even if you're a passive investor, is really straightforward. The structure of market making directly affects your trading costs, price discovery, and overall market stability. Yes, tighter spreads are good, but the current widening we're seeing masks these deep risks of fragmentation and concentration that could boil over during the next market crisis.
Which leaves a really important question for you to think about. Given that these non-bank market makers and HFTs now dominate nearly half of all trading volume, and considering the market's reliance on PFOF to keep commissions low for retail investors, What happens if there's a large-scale, unexpected regulatory crackdown?
No,
How would that impact the structure of those free trades? And what would be the true cost of that reform for the average retail trader?
Thank you for joining us for this in-depth analysis of the infrastructure of market making. See you all in the next ProTicker Deep Dive.